What's up everyone, my name's Robbie, this is Robbie Manila, and today we have, well, in my opinion, it's a pretty good video. One way investors try to beat the S&P 500 is via tactical asset allocation. So what is tactical asset allocation and how can we use that to beat the S&P 500 in 2021? Let's take a look at this chart and figure it out. So, if you see here, you'll see a nice chart from Novel Investor, and it shows here in different columns the sector performance of the different sectors in the S&P 500. So here we have 2019. If we can see which sectors did better than the S&P 500 and which did worse. Now the S&P 500 is the gray box. So this is the box that shows the overall performance of the index. In 2019, it was 31.5%. That was the return of the index. Now, if you look at the sectors that outperformed the average of the index, you have financial services, you have telecommunications, and you have information technology. So if you had invested in just those three sectors, you would have beat the S&P 500. Now, even if you had invested in only the top half of these sectors, you still would have beat the S&P 500 because you wouldn't have these outlier lower returns. For example, you wouldn't have the energy sector with a 11.8% return, which really drove down the average of the S&P 500. So if you took that out, if you had invested in everything except energy, you would have beat the S&P 500. So what we're going to talk about today in this video is how to figure out which sectors in 2021 are going to be the best sectors for us to invest in to try to beat the S&P 500. So hopefully this makes sense so far, and I hope you're excited about this video because I put a lot of work into it, a lot of analysis, and I think I got some good stuff for you, so let's go ahead and let's get started. Okay, let's go ahead and get started, but first, if you're really excited about trying to beat the S&P 500 in 2021, the best thing you can do is hit the like button. Okay, let's go ahead and dive right into this. So the first thing we have is the Schwab sector rating. So this is what Schwab thinks over the next 3 to 6 months, which sectors are going to outperform, and it's put into a very nicely organized type of chart here. So we can see the first thing, for example, communication services. Schwab has a market perform, which means it's not going to overperform the S&P 500, it's not going to underperform it. We have the share of the S&P 500 index that is in the communication services industry or sector, which is 11.2% of the overall S&P 500. The macroeconomic outlook is neutral. The value is neutral. The valuation, for example, valuations of the companies in the sector. The fundamentals of the companies are good, and the relative strength from more of a technical analysis standpoint of how it's trading and if there's volume and momentum and stuff like that is good. So this is kind of the way that they break down what might be a good industry or sector to go into in 2021. Now, here's the thing that I'm going to do. I'm going to give some of my own opinions on this, but a lot of what I have to say, what sectors I think are going to be the best, actually are going to coincide with what Schwab thinks. So moving on to the next slide, I organized this into some different pieces of data. So what I did was I said, what are the ETFs that we could buy to invest in specific sectors? I also said, what are the price to earnings ratios of these sectors, which you can see here. What is the price to book ratio of these sectors? And then I included the Schwab sector view, whether it's market perform, outperform, or underperform. So just by this alone, we can kind of get a good view and good idea of maybe the valuations of these sectors. However, for example, if financial services is at a 14 PE, that only tells us that it's at a 14 PE. It doesn't tell us if it's lower than its historical average, if it's higher than its historical average. Even though I ranked these PEs in order of the lowest PE up to the highest PE, it still doesn't tell us what we really need to know, which is what we're going to look at in a few minutes. But we do see that, for example, the outperform that Schwab has is on the financial services industry at a 14 PE. So it's possible that valuations and the prices of these stocks are not too high, and maybe that's a reason that we could go with a financial services ETF to try to beat the S&P 500 next year, and along with healthcare, for example, which Schwab also thinks is good. Now, healthcare does have a higher price to earnings ratio at 24.3, but that doesn't necessarily mean, again, that it's overvalued or undervalued. We want to take a look at some of the historical PE ratios and price to book ratios of this going forward. So these are all the sector fundamentals and the Schwab equity ratings. Now let's take a look at the S&P 500 overall pie chart that I made. So this pie chart represents how we can see the S&P 500 via its sector weights. So for example, the consumer defense or consumer goods or consumer staples, it's got a lot of names that you can call this sector. It's 7% of the S&P 500 is in the sector, like we saw before. Now, what I'm doing is I'm going to say, do I want to have more in this sector or less in this sector? So for example, if I wanted to make this a 10% weighting, I'm going to have a higher weighting than the S&P 500 does. Meaning I'm going to buy sector ETFs, and I'm going to put more money into this consumer cyclical consumer goods, consumer staples, than the S&P 500. And by doing that, I can potentially beat the S&P 500 if this particular sector outperforms. And what I'm trying to do is find the average of these sectors that might outperform going forward and invest in just those. So let's go and take a look at the different sectors, and I'll figure out which of these we're going to invest in. So the first we have is an underperform by Schwab and myself, and this is the consumer defensive or consumer goods or consumer staple sector. As we can see, the historical price chart has been good. It's outperformed the S&P 500 over many years. Now, the yield on this is 0.75%, so it's not as high of a dividend yielding ETF. So if you wanted to invest in just consumer defensive sector, then I think next year in 2021, it's not going to outperform the S&P 500. So I would underweight this sector. Now, going to the next slide, we can see the differences in outperformance of the S&P 500 here. So for example, IYC is the consumer defensive ETF, or one of the consumer defensive ETFs that you can have, and SPY is the S&P 500. So in 2018, this actually outperformed the S&P 500. In 2019, it underperformed by a bit. And we can see the blue bar chart, the blue bar is the S&P 500, and the yellow is the consumer defensive ETF. So by looking at which of these are outperforming or underperforming, we can kind of get a little bit of a historical idea. But what's important to me is to see how the PE ratio looks, the price to book ratio, and the price to sales ratio looks going back over the average, historical average of these different ratios. So for example, the PE ratio of the sector is at near the highs of the past 20-something years. So that tells me that it could be overpriced. It's possible that it's definitely overpriced, which is one of the reasons I don't think I want to have that much of a weighting in this ETF. Now, the price to book ratio looks okay. So maybe if you look at just the price to book ratio example, it's fine. And then the price to sales is a little bit high. So in general, they're not all flashing red. They're not all telling me that I shouldn't be investing in the sector. But I think I'm okay with saying I'm going to underweight this specific sector. So what am I going to do? I'm going to go over to my spreadsheet and I'm going to say, instead of having 7% in this sector, which the S&P 500 is made up of 7% consumer staples, I'm going to underweight this, and I'm going to say 4%. Moving on to the utilities sector. So the utilities sector is interestingly very highly valued right now for a sector that is not often very highly valued on a price to earnings ratio scale. It's actually pretty overvalued, you would say. What is the reason for this? Well, in times of crisis or economic downturns, people seek yield, and utilities, they pay nice yield. So if you look at this ETF that tracks utilities, it's 2.73%, so not too bad. These have a pretty stable, they're stable companies because they have certain things with the government that allows them to have pricing power and things like that. So people like utilities for stability and to have yield. So The question is, next year, when a vaccine comes around, is it possible that people cycle out of utilities because now they're okay with taking a little more risk? That's kind of my thesis for next year, 2021. I think that there's going to be more risk taken in the market. So I actually want to be a little lower exposed to utilities. Also, if you take a look at the PE ratio here, historically, it's higher than its average has been. And if you take a look at the price to book, it's pretty high. And you take a look at the price to sales, it's very high. So for me, on a valuation standpoint, I'm definitely good with having less exposure to utilities. So I'm going to personally go 0% utility weighting in my portfolio. So I'm going to take utilities out of my portfolio. Moving on. The tech sector. So the tech sector, everyone loves tech. It's done great, especially this year. So if you take a look at tech, it has underperformed the S&P 500 going way back to, this started around when the tech bubble hit. So might not be a great gauge. However, if you had owned it until now, you definitely would have had a higher return than the S&P 500. The tech sector has a low dividend yield, which is something that I think most people understand because you're going for more of a growth-oriented companies. Now, if we go, by the way, tech, for me, because I think tech has had such high growth over the past year, that's why I don't want to have tech as a very high portfolio weighting. So I'm actually going to underweight tech. But if you see it, tech on the price to earnings ratio, it's pretty high. Now look back here. This is the peak, which was the dot-com bubble for tech. You don't want PEs to be anywhere near that type of, those types of multiples. So you wouldn't want that. And we're getting pretty high here in the PE ratio scale. Price to book ratio, we're also high. I mean, we're getting close to the dot-com bubble area. Same with price to sales. So when I look at this, I don't like the multiples that this industry is trading at. So I'm actually okay, even though tech has had a great run over the past year, I'm okay going a little underweight on tech. So I'm going to go and I'm going to do a little bit of an underweight tech play. Weighting of tech in the S&P 500 is 27.4%. I'm going to underweight tech a bit, not by a lot. I'm just going to go down from 27.4% weighting of the portfolio to 23%. So again, what I'm doing is I'm going to take some of these sectors and I'm going to take a bit out. I'm going to put some of that money into, or some of the weighting percentages into some other sectors that I think are going to be better. Okay, so now onto the next one. We have real estate. Okay, so for real estate, since I made this little slide, I've changed my mind a little bit. So what I think about real estate is in 2021, I do think that there's going to be, with a vaccine, I'm actually bullish on the vaccine. So most of what I'm doing is, if there's a good vaccine that comes out, I think that things are going to go well for the stock market and the economy. So I do think real estate is going to actually do okay. And one of the things is I think commercial real estate is going to have a bit of a return for a lot of people. So I think right now hotels and commercial real estate in general are just not doing so well. And I think possibly next year it's gonna have maybe a turnaround. So I do think I'd like to have a little bit more in real estate. So let's go and take a look here. How is the real estate sector doing? So the PE is actually pretty high, partly probably because the earnings of these companies, or the earnings of the companies, have gone down. So I do think it's possible that that's the reason, considering the price to book of these companies is actually really fine, along with the price to sales. So my thought on this is I'm going to add a little bit more to real estate. So let's take a look at the real estate portion. And so real estate is currently 2.6%. I'm going to add, instead of 2.6, I'm going to make this about 4% of my portfolio. Yeah, I think I'm going to do that. So 4%. And I'm going to have to actually take a little bit off of the top ones probably at the end of this, but we'll go with that in a second. So let's go back down to the next one. So we have communication services. So what's going on with communication services? So a lot of people might say that with you have 5G, You have the flight to people working at home and all sorts of stuff. Communication services, one of those things that people might be very bullish on. For 5G, there's going to be a lot of capital expenditures needed and things like that going forward. I don't think it's going to be its year in 2021. I don't think it's going to be a terrible year. So I'm going to equally weight this one. So if we take a look real quick, you do get a nice dividend yield of 2.7%, so that's great. And then the price to earnings is not too bad on this. The price to book is pretty low, and the price to sales is definitely fine, totally adequate. So I'm going to go in and I'm going to just equally weight this. And I'm going to say, okay, the communication services has 11.2% of the S&P 500. I'm just going to keep it like that. So I'm keeping 11.2% in the communication services. Okay, so we're on to financial services. Now, this is my second outperform. I did add the real estate as an outperform, so this is number 2. So this is Schwab has an outperform on financial services, and so do I. Schwab believes that basically the Fed is going to keep interest rates low, which may not necessarily be amazing for banks. However, they think short-term rates are what are going to be maybe cut or kept a little lower. Long-term rates may not be affected that much, and what that might do is steepen the yield curve and help these banks make a little bit extra income, things like that. So there's that's working for them. They're very well capitalized. They have great balance sheets. A lot of this thanks to the 2008 financial regulations that went into place. So right now banks are at a pretty great situation, and they have not had crazy returns. In fact, let's go look back to the return last year. So if we see 2019, financials had 32% return, but the return in 2018 was negative 13%. And actually right now, today, as of the first half of 2020, they were down 23.6%. So the prices of banks a bit depressed, at least in the half of the year. So going back, we can look at some of the prices here, and we can see that the price to earnings ratio is not too bad. It's pretty much, I'd say, a bit under the historical average. The price to book ratio, under the historical average. Price to sales is probably around the historical average. So what does this tell me? It tells me banks are potentially undervalued. They have some room to go up, potential multiple expansion. I think I'm good with buying some banks. So some ETF action with some banks is good for me. So I'm going to go over here. I'm going to say, okay, banks are 9.9% of the S&P 500. I'm going to add a little bit to this. So instead of 9.9%, I'm going to add 11% to banks. So I will be overweight in my ETFs of banks. Or the financial services sector. It doesn't only include banks. I keep saying banks, but it's the financial services sector. So I'm going long financial services. Okay, let's take a look at healthcare. Okay, healthcare is another one that I'm agreeing with Schwab, an outperform on healthcare. So something about healthcare quickly, not too high of a dividend yield compared to some of the other sectors. It's definitely outperformed. Now, why would I be bullish on healthcare? First off, just demographic-wise, we're in a very good area, and also because of what's going on with the whole COVID thing, people are not having elective surgeries, so there's a lot of potential for growth going forward from today. The COVID thing has not necessarily been great for healthcare. It's almost been a wash in a way. So whether or not that continues into the first half of next year, but when there's a vaccine, potentially people start getting those elective surgeries, things like that. Insurance premiums maybe come back a bit. So when it comes to healthcare, I do think it's going to be a bullish industry in 2021. PE ratio is a bit higher than its historical average. Price to book's a bit higher, and the price to sales is actually high. So reason is, I don't necessarily think this is going to be a great play as in a multiple expansion. I just think that the fact that what's going on right now in the healthcare services industry and what might happen next year relative to right now, I think will be good. And so I'm going to add a little extra of this to my portfolio allocation. So let's take a look at the S&P 500. It's got 14.1% weighted in healthcare. I'm going to go a little bit above 14.1%. So I'm going to do 19% in healthcare. So a little bit overweight healthcare. Next, let's go to energy. This is a good one. So energy is somewhere that I am going to deviate from Charles Schwab. So Charles Schwab does not agree with me on this one, but I just see energy as being so cheap right now. I'm going to overweight it. I just think it needs to be done. Prices for energy prices have stabilized a bit. There is some instability in the market, of course, because of what's been going on. Given a vaccine maybe next year, people might start traveling more. There might be more just general usage of energy. So I'm actually bullish on this. You also get a great dividend yield. Now, the risk in this industry is there's a possibility that these companies stop paying dividends. And so you might lose out on some of this yield. And so that can actually hurt you for sure in this industry going forward. But I'm going to take the risk, and I think it's okay for the energy sector going forward next year. Now, if we take a look at what happened in energy, it was one of the worst performing sectors for a few years. So 2014, it definitely underperformed. 2015, it had a terrible year. And 2017, it definitely had a terrible year. 2018, it had a terrible year. And then 2019, it did not have a very good year. So the price to earnings ratio is depressed, the price to book ratio is depressed, and the price to sales ratio is depressed. I think just a little bit of a potential multiple expansion could allow us to have some decent returns in energy. I think this, hopefully, 2021 is the year that we get a little bit of a boost in energy. We'll see, but I'm going to overweight it, and I'm going to do it by quite a bit, actually. So currently, energy is 2% of the S&P 500. I'm going to go up to 8% of the S&P 500. So that is the answer to that one. We'll see how that goes, but I'm hoping that energy is going to be bullish going forward. Let's go on to consumer discretionary. So this is another one where Schwab doesn't necessarily agree with me, but I do think this is going to be something that's going to outperform a bit next year. So what's the deal and why? First off, you have a dividend yield of 1.69, so you get a little bit of yield, not too bad. Sector, of course, has done well over the S&P 500 for a while. So these are things that are fine for me, but the price to earnings ratio is quite high, along with the price to sales, and the price to book is pretty high too. So you might be saying, why am I investing in something that has pretty high multiples, so maybe higher valuations? And the reason is because I think right now, given what's going on with COVID, sorry I'm spelling it because apparently you're not supposed to say it on YouTube anymore. So what's happening with that, and what's happening with these different types of companies in this sector, they're depressed. Their earnings are depressed. They're not selling as much. So a lot of these companies can definitely benefit from a vaccine and a bullish market going forward next year. So if that happens, we can be seeing, I think, an outperformance in consumer cyclical. Schwab doesn't agree with me, but that's what I'm going to go with. So we're going to go to consumer cyclical, and let's add some to our portfolio. So consumer cyclical is 11.6% of the S&P 500. I'm going to add a few percentage points to 13%. So we're up a bit on consumer cyclical. Let's go to basic materials. So basic materials, Schwab has a market perform on this one. I'm going to stick with Schwab. Dividend yield of 1.67%. We have a price to earnings ratio that's pretty high relative to its long-term average. Price to book is a bit high, and price to sales isn't too bad. So we're going to keep this as a market perform right now, and I'm going to go ahead and I'm going to change that. Actually, I'm not going to change it. I'm going to keep it the same. It's currently 2.7%. I'm going to keep it there. Next, we have industrials. So industrials with a yield of 1%, a market performed by Schwab. I'm going to stick with them. And I'm going to also have a look at the PE ratio, which is a bit overvalued. Actually, it's at the highs for the past about 20 years. PEB, the price to book ratio, It's getting up there. It's probably higher in the, it's above average. Price of sales is a bit above average. So market perform for industrials. Now, so I'm going to keep that at 8.4%. So here's the thing. I was not expecting to add to my real estate, the real estate sector. I just realized going through this whole thing that I do think real estate deserves a bit more weighting. So what I'm going to do is I'm actually going to take a bit out of basic materials and and industrials. So I'm going to reduce industrials to about 5%. I'm sorry, 6%, and I'm going to reduce basic materials to about 1.5%, or maybe we'll just say about 1%. And there we go. So that is it. So this is the weighting of my potential portfolio, these ETFs going forward. This is what I'm thinking of having money in to try to beat the S&P 500. Now, of course, this isn't just all of my portfolio. This will just be a portion of it. But let me know if you think that this is interesting. If you want to see me do like a video on maybe buying these ETFs and creating a portfolio of these ETFs, let me know. Maybe we could even track it. Like maybe I'll just do a small portfolio and I could do a tracking update every month or something like that. Anyway, let me know in the comments if that's something that you would be interested in. And so that's all we have for today's video. So thanks everyone so much for watching. Hope you got a little value out of this. You could see some of the ways I think about some of this stuff. Again, if you like the video, please hit that like button. Subscribe if you want to see future content like this. And if you want to watch another one of my videos, I would greatly appreciate it. So please click on that end screen button right now.